Now, next I want to introduce you to Doug. Doug, come on in.
This is so formal compared to what we normally do.
Yeah. So, am I okay here, Paul? No? Only down here? We don't have a shot for here. We need to add a shot for here.
So you can step up and step down.
I can step over here, yeah. So, Doug and I do the radio show together. Now, for all intents and purposes, Doug would be considered a direct competitor to me. Doug has a property management company managing...
We're about 800 doors right now.
Okay, 800 properties. Doug's in multiple markets. Doug has a Wall Street partnership with a different fund from mine. Doug has investors and partners that he works with. We like the same neighborhoods here in town. But how do we do business?
With a handshake. We've done a ton of deals together too. Which, by the way, my wife, because my wife is an avid Facebooker, which Aaron is as well. I'm on Facebook. We always joke because like I've not updated it in years. So like my profile picture is like half my face, right? Because they've done the Facebook update. It's all changed since then. But you're doing a heck of a flip in Fountain Square. She showed me last night.
That's one of Buster's.
Complimenting Buster on that.
My Facebook page is open. I would never have a social media person, so sometimes I have inappropriate things, but they're really funny.
Sometimes you have inappropriate
regularly.
Stuff? Consistently, yeah.
Yeah. But, it's honest. It resonates, right?
Yeah.
But, yeah, I just put one of our flips there. We're not going to that one today, are we? Yeah, so we're going by the first house we're going to see today is one of my flips. So I have the deals that I sell to you guys, I call them wholesale deals because they're rental grade. They're built to be rentals. They're not granite. They're Formica, okay? And then I still always have 15 to 20 flips going on. I have flips in Charlotte right now, flips in Dallas, higher end, staged. Does that make sense? That's just the language that I use internally. So we're going to take you to a flip today, show you a flip first, and then we'll show you some rental grade. We want you to see different kinds of properties. You could buy the flip too if you want it. We'll run the numbers on that and show you. Because you'll love the flip. It's really cute, but it's not a great rental. But people like sexy, so that's...
My point of bringing up the flip was that, two things about our partnerships. One, I buy in Fountain Square and I buy in Bates Hendricks, some of these other neighborhoods that Aaron buys in. And two seminars ago when I was here, Aaron was, the realtor he prefers to use in those redevelopment areas for flips was in the audience. And he was, speaking very highly of her. And I said, can I use her? He's like, yeah, absolutely. Sent me an email with her contact information. And I mean, it's a free flow of information because we believe that together we can create more wealth for one another than we can just competing with one another and trying to guard our little fiefdom.
Yeah. I met Doug because some people ask me where we get properties from. We don't buy them on MLS, I'll tell you that. Okay, we get properties 4 ways. One, we do direct, we work with wholesalers here in town. We do a meetup, meetup.com, the website. We do a meetup where local wholesalers come to my meetup here every month, and I teach them how to sell to me. I'll say, I want to be in this neighborhood. I want to be this much all in. I want to be in this. So the best deals Brett, how many deals a week are we getting from wholesalers right now? Yeah, about 8 deals a week. And my best returns on investment are wholesalers. How are they getting deals? We buy houses, signs, letters, okay? And then they bring them to me. And the way that it works is, let's say they get a deal like that one that I showed you earlier that burned down. I paid $29 for it. If the wholesaler got that under contract for $25,000, and he says, "Hey, Aaron, what do you think at $29? Here's the pictures. Here's the condition." And I say, "Yeah, $29 is great." Then he says, "Okay, good. You're going to buy it from the homeowner for $25 and write me a check for $4." Does that make sense? So my best wholesaler here in town makes $300,000-$400,000 a year, just on the markup, and she never has to put any money down on any of them.
Which, by the way, you and I agree. We've never begrudged a wholesaler for making money because they're providing a service. It's so funny. Like a lot of the investment funds we work with will not buy from wholesalers
because they don't like the markup.
Yeah, they don't like the markup. What they don't understand is that wholesalers are paying for their marketing and advertising costs. Right? They're going out. They're functionally acting in many ways like a broker and uncovering deals, and you're paying for that service. But for whatever reason, certain people just have a visceral reaction to it that it's a negative
fund
thing.
Wouldn't buy from wholesalers. They wouldn't let me buy from wholesalers.
90% of the funds will not buy from a wholesaler.
They think it's an opportunity for fraud. So they're afraid that somehow I've propped the wholesaler up, and I'm making the spread. And God forbid I make too much spread on the deal. Like, they freak out about that. They freak out all the wrong things. It's been really interesting because if you think about it, for years, Doug and I were in the single-family home game, and we were considered the least sexy. The only thing less sexy than us in real estate was what? Mobile homes. Okay? It was mobile homes was the dirt of real estate, uncool. I mean, imagine being in first class on the flight and be like, yeah, I'm a mobile home investor. I used to do hedge funds, but that sucks. You know, compared to, I'm a developer, I'm a commercial developer. I see people that, I'm always like, oh, I'm sorry. Your deals suck. Welcome to 5% forever, right? I'm a builder, I hear that one. I'm a builder, I do custom homes. Oh, so you enjoy making 8% profit, because I'm building 17 homes right now, and it's not very much margin. The sexiest deals that I've ever done are mobile homes. I had a park that was making 40% a year. Put that in the rule of 72. Okay?
I know that we're being filmed. Can you tell some of the backstory on that mobile home, or is that not possible?
Yeah, Doug heard about that.
Maybe afterwards. Maybe.
I just said, let me just lay out a hypothetical for you. Hypothetically, if you were to buy a mobile home park in the state of Nevada, and you weren't aware that when you get outside of Clark County, which is where Las Vegas is, prostitution is legal. And hypothetically, if you had a mobile home park in a county with legalized prostitution, and prostitutes pay a 50% commission to the brothel legally, and those hypothetical prostitutes realized that if they moved into the mobile home park full of miners working at the copper mine, that it would create direct access to business, hypothetical business, with no 50% overhead charge, and you hypothetically got a letter from the city of Ely, Nevada, fining you for not having a hypothetical license for a brothel, it would be traumatizing to your wife. When she opened that letter.
I actually didn't know that part that you got cited.
You know, as you look back on a marriage, you see points that were cracks in the foundation of that relationship. She was not, I heard the same frustration in her voice when I wouldn't put the 10 grand in the Ponzi scheme as when I got the brothel letter. That's funny, Megan. You know? It's like, don't waste time on hookers. Get back to the
She's telling us to move on.
So Doug heard about it. Yeah, it was horrible. So they were fining me for not having a license. I'm like, they moved in. They were just renting from me. I wasn't getting any of the. I was like, girls, you should have at least offered me a cut, you know, because the whole reason the park filled up was they opened Kennecott Copper, the mine, and so all the miners came in, flooding in, and there was no housing. It was like North Dakota, you know, with the oil and gas. And prostitution's legal in Ely, Nevada. There's a brothel, and yeah, that was interesting. So once I got them on a payment schedule. But yeah, mobile homes are the best. And so there's this, people like trophy properties. I don't care what you say. There's an asset class of real estate that you think is sexy. And it should be return driven. It should be return driven. I always worry when I meet someone that's like commercial is the only way to go. Why? How about just good deals? I own commercial property. I've invested in commercial property. I like a commercial multifamily. I own commercial retail. But they're all good deals. They're 15% deals. For me, there's no cool asset class. That's a 5-figure rookie mistake that you make. But I get that people want trophy, but this is a fourplex I own. I only do. My properties are a work of art, you know. People do. There's a flipper here in town, and she says each property is a work of art. And I said, well, what kind of returns are you making? She's like, single digit. Pure ego. It's pure ego. It's your pride and your ego that's blocking you from making more money. For many of you, that's the case. That's like when I had my MBA and I started a blind and window washing company. I knew that there were many of my classmates that would never do that because I washed the windows on the first 1,000 houses that we did. with an MBA, whatever. I was making $300 3 or 4 times a day. Scoreboard, all that matters is the score at the end of the game. Scoreboard. I was killing it. But I had my contemporaries like, no, I have an MBA. I need a white-collar job. I need the right kind of job. And people will ride that mentality to $75,000 a year. That's stupid. In New Jersey, we had a septic tank at our house. Now, with 7 kids, there was always one section of our lawn that was really green. Because when we all took showers, it would seep up into the yard. So my dad had to get that pumped every 3 months. And his funny thing to do was to tell, I'm the oldest of 7, would be to tell 2 of us to go up and pop the lid. Because literally it would knock you over if you were breathing incorrectly when you popped it. So the other kids would watch because he'd be like, he's like, he'd hit the ground. So we're out there one day, and he makes my brother's brand name pop the top, and septic guy pulls up my desk, starts laughing. He goes up and they like do the awkward bro hug. What up? And I'm like, what is this? Well, the guy, they talk. My dad comes back. He's just kind of giggling to himself, and I said, what? And he said, that guy's a lawyer, and he used to work for the firm that does our litigation for the casino. This was in Jersey. And I'm like, what is he doing? And he said, well, he told me that he has a septic tank at his house, and he had to get it pumped, and he paid the guy $300 for 5 minutes of work. And he said to the guy, how much do one of these trucks cost? And they cost $75,000. And so he went to his partners in the law firm, and he had them buy him out. And he bought 3 trucks. And he said, now I make double what I made as a lawyer. Everybody likes to pay me. Nobody liked to pay me before. Everybody's happy when I arrive. Nobody was happy when I arrived before. And he said, ironically, I still do the same thing that I did as a lawyer, which is sling shit all day long. And he's like, the only difference is I just put some mentholatum on my nose. And my dad said, that is a life lesson about work, your ego, and the convergence of them and how detrimental that can be. What a mindset issue it can be for you is that if you think there's only a certain kind of work that's right for you based on your education, background, or experience, it's a giant blind spot in the way that you're viewing the financial world, and you will miss opportunities, you will miss partnerships, because your ego holds you back from that. No, I'm above that. I am above that. Does that make sense? Okay, very, very powerful, and it's something that we have in common that we laugh about. That think about this now. Doug, what range is private equity paying for property management companies now?
Oh, you mean what?
Times earnings.
Oh, times earnings. Anywhere from on the low end 2 to on the high end, 8. We've seen one priced at 10 times earnings.
Okay, now think about this. The way they buy businesses is they say, how much money do you make in a year? And then the value of your business, I'm going to K through 12 this because you can see he's much smarter than me. He's like Brittany. And
by the way, thanks for letting me come up after a biochemist. He's like,
Whatever,
she's so
dude.
smart. Here's a biochemist. Come on up, Doug.
Now that Brittany's gone, you're the smartest person. You guys are like, it's a competition for the smartest people in the room. Okay. So what they say is, okay, so you made $100,000 this year, then your business is worth 2 times earnings. So your business, I'll give you $200,000 for your business. Does that make sense? Isn't that easy? I just K through 12 that for you. So for years, like a dental practice is only worth 1 times earnings. And one of the reasons that drives the value of a business up is how easy is it for your clients to leave. So if I don't like the new dentist, am I going to go back? I'll just get a new one. It's really easy for me to change because I don't need the experience of the last crown to fix my next one. Does that make sense? So there's a very low multiplier. What is it? A multiple.
Yeah, and
Very low multiple that they pay for them. Mm-hmm. But why is it so much higher for property management companies?
So part of it is that the clients are considered sticky, right? So that once you find a good property manager, you're not likely to leave, and you're highly vested in that. The other thing, though, is a good property management company is extremely hard to find, right? And so, not to digress, you probably talk a little bit about why Rob liked you a lot, right?
No, we didn't actually, I didn't.
So when Aaron and I noticed that Wall Street was getting into the game, private equity groups were getting into the game, I think the first question was, can you buy $100 to $200 million worth of houses quickly, right? That was kind of the first question. Can you even physically do it? The answer is yes. Any idiot with money can buy houses, by the way, right? And then the question after that was, can you make them perform, right? And so that has been what everybody has come to realize, is that the most important piece of your real estate investing is the ability to make the properties perform. That's why a property management company is so valuable when you find a good one. I mean, think about how much broken glass Aaron and his team have had to walk over to get to where they're at today. How many ways you guys have lost money figuring it out, right? I mean, real estate's not, property management and rental investing is a mile wide and an inch deep. And what I mean by that is, no problem is complex, but there's a million of them, right? And you have to put a process and a system around every single one of those problems, or they're going to bleed you dry. And that's what Aaron and his team's been able to do. And that's what private equity has realized, is that the folks like Aaron and Alpine that have figured out a system to make properties perform are extremely valuable. And you can find all, Aaron, you're out of frame. You can find all kinds of property management companies if you just Google them, but they're not all created equal. That's why they're so sticky. That's why, Alpine would be worth a high premium to a company like that, because they've got great systems and processes, and clients aren't going to go anywhere.
So it's funny because we keep 10% of the rent, and then we own a construction company. And so I've found that if I mark up the construction 15%, that covers all of my costs.
Which is below average, by the way.
Oh, most construction companies are cost doubled. Cost plus 100. So, for example, on a 1,000 square foot house, usually a contractor, if you come get an estimate to put a furnace in, he'll charge you $2,500. Does that sound about right for a furnace? Okay. We found that the furnace costs about $600. Okay. And we can get it put in for about $600. So I can do it for $1,200. So I just take my cost and then add 15%. So I add $180 onto $1,200. So if you have a furnace go out on your house, then I'll send you an invoice for $1,380. Does that make sense? Whereas you work with XYZ other property management company, he's like, cha-ching, $2,500. Does that make sense? And so we found that that was enough to cover our costs and to run a profit. I'm okay with 3 to 5% profit. I was fine with that. And cover my costs plus 3 to 5% profit, so you could have a buffer. But think how we felt, because now I got 2,500 properties under management. Doug's got 800. And all of a sudden, because Wall Street's been in the game, and this was the fund that I had a partnership with 510 Capital, I bought 600 properties for my fund as a partner, and we just flipped them all to Cerberus Capital. It was in the Wall Street Journal a few months ago. And then they had them manage for us. We got to keep managing them.
Wait, before we teach anybody anything, we have to tell one of my favorite Aaron Adams stories about. So you can see he's obviously, and Rob's a very nice guy. He's very buttoned down, right? Very professional. So Aaron calls me up. Was it 2 years ago? 3 years ago?
It was 2013.
So he's like, "Hey, have you heard of 510 Capital?" And I hadn't at that time, though they're very successful. Rob's a very successful guy. And I said, "No, I haven't." He said, "Well, he wants to do a tour of Indianapolis and see, what we do, and if we can provide services for him. Would you come along?" And I said, "Sure, yeah, I'll come along."
Well, Doug moves in the Wall Street world. Okay, he knows the top guy at Blackstone. He knows the top guy at Colony County. Like, his world has always been institutional, Wall Street, funds, hedge fund, private. That's the world he moves in. I've always been more of a individual investor kind of guy. So when this guy calls me up, he's like, "My name's Rob Lomker. I've raised $300 million from my partners." I mean, look at his work experience. Putnam Investments, Lehman Brothers, who almost ruined our whole economy, and Solomon Brothers. But
you're on video, Aaron. You're on video.
Yeah. Oh, yeah. He has managed investment teams managing over $60 billion in assets, okay? So he basically in 2012 made a few phone calls and raised $300 million. And then he said, I'd like you to be one of our partners, and I'm in the process of borrowing another $100 billion from Deutsche Bank, and then we want you to buy, since you already have Kansas City, since you already have Indy and Dallas, we want you to buy houses for us, and then we'll pay you $5,000 for every deal that you buy for us with our money. How great is that, right?
So...
Anyway, I say to Doug, I don't know, man. I don't know if I want to work with that guy. He doesn't know anything about real estate.
Well, so Aaron and I so he's like, but I'll do a tour, right? And I said, sure, I'll come along. I said, so we're wearing suits, right? And it's a Wall Street guy. Like, so we're getting dressed up in suits. He's like, no,
Hell no,
man.
I don't wear suits.
He's like, I'm wearing camo shorts and my flip-flops. I'm like, okay.
And my gun. No, I wear that every day.
So
I wear shorts and flip-flops almost every day.
So I show up at Alpine's offices, and we're going to go pick Rob up at the airport. I'm like, so do we want to take, my SUV? What do you want to take? He's like, no, we'll take my what was it, a Jimmy, a Bronco?
It's a restored Bronco. Like,
jacked up, by the way.
so it's got Mickey Thompson tires that are like that tall, a 4-inch lift, right? It's restored beautiful. I spent $20,000 on it. Could climb any mountain. But it doesn't have like an oh shit bar. So I've seen people have to like climb up on the seat and then turn around to sit up. And it's only 2 doors. Because in the summer when the top's off, my kids just climb up on the tire and then hop into the back, right? So if the top's on like it was at that point, then you have to like climb in the back. So we pick up Rob at the airport.
Not very client-inducive. And certainly didn't paint a picture of Aaron's success, right?
We get to the airport and Doug's like, do you want me to get in the back? I'm like, no, he can. He comes out in a suit and I'm like, hop in the back, bro.
So I'm leaning, Rob's a very polite guy, and Rob comes in, okay. He squeezes in, and then Aaron immediately reaches into his pocket and pulls his gun out and like puts it on the thing, and Rob's like, well, Rob's wondering what he had gotten into at that point. He was a good sport, though. Rob was a he's a
cool dude. And when we sold the Cerberus, he made like $20 million. Like killed it because it was all his little baby. And that's how that world works. You get paid before you've done anything.
But
oh wait, that.
What did I think one of the interesting things, at least when we're always talking to folks about this stuff, is how did Rob really vet out? Did he go see a bunch of houses?
So here's what 5-figure investors come to this event and they go, how many dogs do you allow in the houses? Well, what kind of people are they? Do they have too many kids? Because I don't want a bunch of kids living in my house. I get those kinds of stupid, this is your investment. Aaron, why is the fence look so ugly like that in the backyard? Well, because if I fix it and then your tenant breaks it, since it was fixed when they moved in, I have to fix it again and charge you for it. Because you still think, I'm going to live there, so it needs to be sexy. And you project that onto your rental property. Guess what? All of our houses you'll see today are the same color. All the walls, the windows, the roofs, the carpet, they're all green. Even my tenants are green. Because it's just money. It's an investment. You're not living there. If you see it as anything other than green, it's the beginning of the end for you. We had an investor at the bus store say once, I would never buy a rental property if I wouldn't live in it. And what'd you say to him, Megan? He's like, you're right. That was a mistake. I'm like, this is blue collar housing. This is a lot of house for $650 a month. It's clean, it's fixed up. Yes, it's cheap carpet, but it's new. Yes, it's cheap paint, but it's new. Yes, they're cheap mini blinds, but they're new. I would let my child play and live in that house. There's no Board of Health issues. There's no mold. There's no leaking water pipes. It's clean but cheap. Does that make sense? And we get a lot of people that have a problem with that. No, that's not cute enough. Can't we add some more color? Because they're projecting. Well, when Wall Street comes in, they go, okay, background check first before anything. We want to vet you out. Okay, now that's good. No felonies, no convictions.
You did run a brothel.
Yeah, illegal brothel. And then what kind of software do you use? What kind of property management software do you use? We use the standard. It's Propertyware. There's two main. There's AppFolio and there's Propertyware. They're very standard. It's web-based. You can log in and bring up your portfolio and see all your P&L all laid out there, ready to send to your accountant. Okay, it's very. So he's like, oh, good. We love Propertyware. And background check, okay, and let me meet your team and see how they divide the labor up. Okay, this is great, and let's go look at a few properties. I'm good. So when he vetted out the whole operation and saw how the machine was put together, he didn't have to stand at the end of the machine and watch every widget come out. Does that make sense? That's why most of our investors come to this event and see the whole operation, and then they sit down with Megan, and they say, I get it. And I get it that it's going to be the same in Charlotte. Because do you guys not use Propertyware? Same systems, same team, same Alpine. And And that's why we want it to be like with your financial planner, that you don't have to come back to the bus tour every time you need properties. Okay, that's why we have it laid out this way. So there's the overall structure that we have. GK will like it because when you do, one of the best rules of asset protection is to divide up your business activities, right? It's so easy to start an LLC. Now, tomorrow when we talk more about it, I'll literally log into my bank and show you all the different entities I have on my profile. It's like 26 different companies. Some people say, oh, isn't that confusing to have all those accounts? I'm like, no, confusing is to try to run it out of one account. That's a nightmare. Never do that. It's easier just to set up a new account, a different debit card, a different QuickBooks login. Now, it's complicated for Dana, but that's what her job is. That's called job security. So and when you're in it every day, it's really easy. Does that make sense? So Alpine Capital Solutions, we only use it for marketing. We use it for this event. I don't buy houses with Alpine Capital Solutions, but I pay for the website out of it. I pay for the radio show out of it. I pay the caterer for this event out of Alpine Capital Solutions. Does that make sense? Okay. Alpine Property Management, I started in January 2005 here. When I'm in Hong Kong and Singapore, I teach them how to investigate fraudulent US companies because they get a lot of companies pitching them. I said, always be concerned if you see a person who says, I've been in business for 20 years, and you look up their LLC, and the LLC's been around for 6 months. Because when people get a lot of complaints or a lot of fraudulent activity, they just shut the company down and start a new one. Does that make sense? I'm very proud of the fact that January 2005 is when I started Alpine Property Management, when I left California. In a second, I'm going to talk about why I left California. Doug and I want to talk about how we evaluate market. You okay on time? Sure. Okay. We also started a construction company when we started a real estate brokerage. 3 years later, I was in Dallas. I wanted more appreciation. Okay? These two markets, Kansas City and Indy, you're getting like higher cash flow and more stable and lower appreciation. These two, Dallas and Charlotte, you're getting higher appreciation and lower cash flow. So we initially went into Dallas because I wanted some of that 10 to 15% appreciation. Trade-off is you get lower cash flow. Homes from these two markets we sell for about $100,000. Okay, they're rented for $800 to $1,200. Homes from these markets we sell for $60,000 and $70,000. Do we even have any Dallas available, Megan? One. How many Charlotte do we have?
3 or 4.
A few. Okay. It is a bloodbath to get properties that are actually good deals in these markets. That's one of the reasons why Brittany's leaving, because she's got wholesale leads she's got to go check out. It's Aaron knows it's a dogfight to get props. Okay, and that was what Rob wanted to invest in, was this structure that we had. We were in Florida for a while. We left Florida. We are managing our last Alpine property in Florida. And all of the investors left together. We were in Houston a year ago, because obviously Brittany knew Houston. We're not in Houston anymore. We were in Omaha for a while. We're out of Omaha. When we exit a market, then we let you know, and we manage it for you until it's sold, and then our newest market's Charlotte. And so all of my Florida people have been reinvesting into Charlotte. Does that make sense? We have a very national scope to evaluating markets. Doug does as well. So these are the criteria that we use to evaluate markets. These four. Now you have to have all four of them together, or it doesn't work. So, cheap houses. Does Detroit have cheap houses? Yes, but does Detroit have jobs? No. So Detroit's out. Does Hawaii have plenty of jobs? Yeah, pretty good. Do they have population growth? Yep, pretty good. They do not have a business-friendly state government, and they sure as heck don't have cheap houses. Does that make sense? You have to have all four of these criteria, or it doesn't work. Now, When it deals with jobs, I want to see less for 10 years. And I want to see more for 10 years. What do I mean? Oops. Okay. For jobs, I want to see lower than the national and regional unemployment rate for 10 years. So I want to see a market that has outperformed the national unemployment rate for 10 years and the regional area. So for example, the national unemployment rate right now is 5.5%. Indy Metro is at 3.5%. It's been below the national unemployment rate by 2 to 5 points for the last 20 years. Does that make sense? That's a really important statistic. It needs to be at least 10 because it speaks to the stability and the diversity of the job market in that economy.
Yeah, that's one key point that we always talk about too is like people pick on Dallas. They think Dallas is an oil-based economy. It's not. It's a very diversified economy. And so we're going to pick on Detroit again real quick. Detroit had a lot of jobs and a lot of job growth for 20, 30 years, right? Especially post World War II and everything else. But the problem was the economy wasn't diverse, right? The job base was pretty much all spawned from the auto industry. So you take central Indiana, you've got, of course, the state and the city government. You've got health insurance. You've got diagnostics companies. You've got logistics because of the way the city's geographically located in the United States. We're within a day's drive of 50% of the population. So all these different things create a diversification of the job base so that if one particular industry gets hammered, it doesn't negatively impact the totality of the economy. Look at San Francisco. One of the reasons, Aaron and I always talk about it. Look, it would have been great to have been there 10 years ago, but what happens when tech pulls back at some point, right? And it'll pull back at some point. Right now, it's going crazy, but the housing market's being driven really primarily by one sector. So you're not diversified in your risk. You're really exposed to the tech sector if you're buying homes in San Francisco. Does that make sense?
So this economy here, you have Eli Lilly, you've heard of, giant pharmaceutical company. The state of Indiana is second in the nation in healthcare medical devices, behind only California. Okay, healthcare, Anthem Blue Cross Blue Shield, world headquarters, right next door to the Columbia Club, right there on the circle. Okay, so healthcare is big. This campus and 3 other campuses, it's 100,000 full-time students. Now, I like to see a market of at least 2 million people. Somebody said to me earlier, well, what do you think of Albuquerque? And I'm like, isn't that less than 1 million? And they're like, yeah. And I said, it's off my radar. Because money is made in a real estate economy, or money is made in real estate by inefficiencies in the market. Money is made by inefficiency. For example, when I'm in Idaho Falls, where my kids live, I'm there every 10 days. There's only 100,000 people in that valley. There is no such thing as a deal that sneaks by the auction, because you have a few investors that cover that whole market comprehensively and completely. You think about here in Indy, you have 2 million people. There isn't any one company that covers the whole city. It's too big. And so that overlap creates gaps where good deals fall through the cracks. Does that make sense? Okay? So those inefficiencies create money and create opportunity for money. I personally think that you need to be in an economy, and for our model, that's got at least 2 million people. That's an important criteria. Look at some of these headlines about Indianapolis. State unemployment rate, 8-year low. We have a $200 million annual budget surplus, and we have $2 billion in reserves here in the state. I have to explain in Hong Kong that states are good or bad with their money. States are business friendly or business unfriendly. What are the 5 most valuable corporate brands? Okay, Cummins, $2.7 billion. Eli Lilly, $1.7 billion. Medical device, like I just mentioned, $1.3 billion. Simon Property Group, $1.3 billion. They own all the malls. If you've seen a Simon gift card, that means they own your mall. Okay. Indianapolis outranks Chicago for best city for jobs. Indiana has the best Midwest business climate. Amazon, digital marketing. Unemployment, Rolls-Royce putting $600 million here. It's the racing capital of the world. The Indy 500 is the biggest sporting event in the world every year. We host 400,000 screaming, Bud Light drinking rednecks. Okay? Actually, Pabst Blue Ribbon drinking. Okay? Look at Charlotte. Second hottest population growth in the nation behind Dallas. Low unemployment. Second largest finance and banking after Wall Street. It's huge. Explosive growth downtown. All of our houses are downtown. Racially diverse population. Mild climate. No hurricanes. No snowstorms. Good for property insurance. That was one of the reasons we left Florida is getting wind and water insurance for a landlord policy was up over $200 as a rider. It just became prohibitive. It was eating our cash flow. Business-friendly state government. Okay, look at some of these ads. Okay? When you do macroeconomic research like we do, based on these criteria, then dynamics just start jumping out at you, and opportunities jump out. It makes it easy to see why Chicago is great for flips, but not good for rental holds. Many of you that live in those markets like California, Chicago, New York, Florida, I love those markets for flips. Like I said, I do flips all the time. But you don't want to try to passively invest for the long term. That's the why behind what we do.
Yeah, and one of the things, talking about cheap houses, we're also talking about relatively cheap houses. So historically, median home prices usually track around 3 times the median income of a family of 4, right? So to make it simple, if a family of 4's median income is 50 grand, home prices are about 150. Does that make sense? So one of the beautiful things about Central Indiana is that we're tracking at 2 to 2.5 times the median income. So homes are extremely affordable. So what that also tells you is there's a lot of room for home price appreciation, right? So if you have positive population growth, you have positive job growth, you have good median incomes, and homes are still affordable, then there's a lot of room for homes to go up in pricing and still be affordable for people to buy. One of the things we don't like about Southern California is it's detached from the fundamentals of supply and demand, in that there's not enough people who can afford to buy those homes in the long run. So they'll spike and then they'll go down, right? Because it's detached from affordability. All these markets are still very affordable markets. So not only can people afford to rent, they can afford to buy, which drives the long-term value of the property. Does that make sense? So it's not just cheap in that, like they said, in Detroit, it's a $1,000 home. It's relatively cheap to the median income of the people in the area.
Yeah. And when you're talking about population growth, I want to see higher than the national average for 10 years. So there's 600 people a week that move here, net growth. Okay? If you think about it, unemployment and population growth encompass so much about a market, because think about when you've moved, what a big deal that move was. People don't relocate just on a whim. You don't pick up your life, pull your kids out of schools, hire the mover, pack up, and move to a different state, especially if you're not from there. Population growth and population shifts are one of the reasons why here in the U.S. we have appreciation, and why you have Detroit depreciation, where you're losing value. That's why we have that. You think about the UK, it's pretty much static. You don't have people like migrating from London up to Scotland. It doesn't happen like it does here in the U.S. It's actually a very unique dynamic of our U.S. economy, these population shifts, people moving to the Sun Belt, people moving, coastal. Those migration patterns that we do here drive appreciation. Now, we won't buy houses in a neighborhood unless we think there's 10% appreciation potential. Every house we sell has an argument for why over the next 3 to 5 years it will make 10%. Let me show you an example of how. This neighborhood, this article just came out 2 days ago. In fact, Paul, I'm gonna step off the camera so you just put the slide up. So, City Council gives go-ahead to 16 tech bonds. The City Council voted unanimously Monday night to approve $75 million in bonds for infrastructure improvements to get the 16 tech development off the ground. So the City Council just approved whose money? Our money, the city's money. $75 million to fix up a ghetto neighborhood here in town.
Is that the technical term? Ghetto?
Ghetto. Now, ghetto to me is not racial. Ghetto is low income, high crime, low home ownership. You got white ghetto, black ghetto, ghetto's ghetto. Does that make sense? So the city's going to throw in the first $75 million in infrastructure. What's that mean? Streets, utilities. Yeah, okay, so they're going to fix up the neighborhood in exchange for $100 million in tech. So if you have a little tech company, they get a private organizations who want to foster a little tech community to spend $100 million in that little neighborhood. And then over the next 5 years to spend another $400 million. What do you think is going to happen to that neighborhood now? What do you think is going to, I could get houses up here for $1,000 2 years ago, before they started talking about this. Because it was bad. Drugs, drive-bys, low home ownership. What do you think it's going to look like 5 years from now after they've spent $500 million here? Okay? Public-private partnerships. I read the city council minutes religiously. Those are like my Bible. Because when you see a public-private partnership, it creates ridiculous, and then you can go to the nearest neighborhood that's low income now, that will change that neighborhood to blue collar and middle class. And so we do that in Dallas, we do that in Charlotte. Every house that we buy in Charlotte has a reason. Maybe it's near a rail line that's coming through. Maybe a developer has got a bunch of free land from the city, and so they're building new homes because you have this housing shortage in Charlotte. And so I can buy the formerly ghetto neighborhood that's going to now transition to blue collar because you got brand new homes being built 2 blocks away. Does that make sense? So one of the things as you meet with Becca and as you meet with Megan and discuss properties is get your mind around the why behind those neighborhoods. Because we specifically target a minimum of 10% appreciation. Now, if you bring up Indy Metro appreciation rates on a Google search, it'll say 5%. Because you have some negative appreciation neighborhoods, you have the suburbs that don't do anything. But we have a very deliberate approach, and that's one of the things I want to show you as we go out on the bus today. Okay? But that's a big piece. Because if you're making 10% from the rents, and then you make 10% appreciation, it's 20%. 20 goes into 72, 3.5. Is that sexy? You understand now? Okay. I know Doug's got to go, but just like with Brittany, do you understand why we like working together? You want business partnerships where their strengths complement your weaknesses. For many of you, the ego associated with that is very difficult for you to overcome. Because you want to work with people who are like you. So I met a management company, and they're like, well, we only work with Christian employees and Christian investors in a Christian environment. And I said, I can see why that was appealing, but do you realize the opportunities for missionary work that you're missing? Like that alone, right? And I feel like you sell yourself short when you want everyone to be like you. Okay? You got these different personality types. I always, now my children's mother is a psychologist. She's got a PhD. And she does those personality, you've seen those Myers-Briggs personality tests? They had all these like different variations. And I'm like, actually, it's just really like 4 characters from Star Wars. You have Darth Vaders, that are your alphas, right? You have your extroverts, that are your Jar Jar Binks. Okay, you have your analyticals, C-3POs.
I told him I'm the worst character next to Jar Jar Binks.
Doug is the only 8-figure net worth investor that I know that wears Skechers.
I'm Chuck Tailoring today.
He's
I'm doing
Chuck
Chuck
Taylor.
Taylors today.
I
Not
always-
the fancy. There's an upgrade to Chuck Taylors, which I was not aware of. These are the low end Chuck
On the
Taylors.
radio show, I call him the Skechers millionaire. Actually, we have the
How have
deep
we not
voice
got
guy.
sponsored by Skechers yet? Like, how have they
We
not
need
sent
that.
us some shoes? We
need-
talk
we
about
need
it
that.
a ton.
It's funny because Doug got married just a couple of years ago. And because he's so modest and like laid back, as I was getting to know his girlfriend, then fiance, I realized she had no clue how much he was worth. Right? And because like we're Facebook friends, and she still will like get into multi-level marketing companies. Now I know a lot.
She
of
really does.
We know,
She
now,
does. Avon. What are the other ones she was doing? She was And I always end up having to buy all the property.
He's got to buy everything that's in their garage, like to bail her out. He's like bailing out the Lehman Brothers of his neighborhood. His wife.
Jamberry nails or whatever it was.
Yeah.
Oh, man. And then Aaron all he does is just tease me the entire time. He'll send me pictures, screenshots of her Facebook when she's in a new MLM.
So now
He's
she's in, which one? Mary Kay now. She's
Mary Kay, that's right. Said Avon, yeah.
So I just had this vision of them at home, and she's like, honey, so I went to this meeting tonight, and they showed me these projections for Mary Kay. Do you realize if I get 40 people in my downline, how much, Doug, we could have like 20,000 a month. And I'm thinking, Doug's going, yeah, I made that the last 2 days, but
She's
no idea.
She's well aware now because Aaron makes sure she's aware so that I go buy her nice thing. Like every time we do dinner, it costs me some sort of expensive purse, some sort of
Because I feel like
furniture.
I feel like, Alicia, you deserve a Chanel bag. Why you don't have one is beyond me, but you should just go buy one. Doug, get her Michelle. Doug's like, what? How much are those?
A couple $100? What are we thinking?
$5,000.
Yeah, just don't worry about it, Doug. Yeah, that's exactly, yeah, because Aaron has me outfitting her.
I was like, because they bought a house, and so Doug gave her a budget for the living room for furniture. It was like $1,500. I'm like, dude, you're not living with your buddies.
Yeah, I was like,
anymore.
$1,500, that'll work, right? Aaron's like, that'll buy maybe a chair.
I said, add a zero, Alicia.
How much, Aaron, how much were your shoes? Let's talk about your shoes.
$600. You know, they're comfortable. It's about.
I could get 10 years of shoes for that.
So anyway, we go around like this. This is the radio show. That and pick on Ellen. Now, and then you have your caretakers that are like your Ewoks. So I tend to be more like Darth Vader extrovert because you tend to be two personality types. Doug's like analytical extrovert. Ellen is like Darth Vader. Show them the t-shirt one of your investors just sent you. One of our investors just bought this for Ellen. Send it to her. She just got it today. I rest my case. Okay. Now, what do you think? What do you think Megan is? Ewok, Jar Jar Binks, Darth Vader, or is she a C-3PO? Well, they say my ex-wife said that if you have all four personality types, then you're called a sociopath. Okay? Everybody has a little bit of each, but you tend to have two dominant traits. So, like Ellen would be like alpha. She'd be like Darth Vader mixed with C-3PO. She's the rare alpha analytical. Becca's like 100% Ewok. You are. I wish Alana was still here. She could hear that.
She is. She's organizing simple books.
You're not C-3PO. You're not Alpha. Oh, you're Ewok. Jar Jar Binks. Remind me tomorrow. I have a video. It's in my computer. It's called Becca Party. It's really great. Before we start. Now, Megan. What do you think Megan is? There is zero Ewok in Megan.
Children.
No. You know what Ewok? I've avoided that excuse. For a while, they'd be like, no, I'm a caretaker. Like, if you don't love your kids, then you're a sociopath, so that doesn't count. It's like Chris Rock says, you don't get credit for doing shit you're supposed to do. You're supposed to love your kids. You don't get credit for that. Megan's like alpha extrovert, I think. Dana, analytical caretaker. That's why Dana and I work so great together. See, she's the exact opposite. That's why Ellen and I and Doug fight on the radio show, because my inner alpha always wants to like break her lightsaber. You can't have two Darth Vaders in the same company. But it's actually great because Ellen, we're going to talk about what she does here in a couple minutes, but Ellen runs her whole section of our company like its own little company. She's completely autonomous, almost completely independent, and one of the reasons why I love having her in that role is knowing what her personality type is. It allows me just to know that she'll own it as if it was her own startup. Does that make sense? Okay, so when you meet other alphas, your goal needs to be, how do I get them as my partner running another company? not as my employee. Like Brittany is very alpha, and she works great as a separate company from me, not an employee. Make sense? Now Buster is alpha because he's my cousin, but he runs the construction separately. We still butt heads, but Buster's wife is a total caretaker, Carmen. That's a good match. But do you see how important that dynamic is as you look at partnerships? So when you find someone who has that complementary personality set, tap into that, own it, and never take credit for the things that they're good at. Nothing will ruin the relationship you have with your employees or your partners than pretending that you're good at what they bring to the table. They'll hate you for it. If you take credit for the successes because of it, it will just be a cancer in that partnership or that relationship. Never do that. That is your pride. Does that make sense? So I appreciate you coming in, man.
Thanks for having me, guys.
Give him a round of applause.